This is going to be a walkthrough of the exam 2 practice. So question 1, Floric Incorporated produces and sells a single product. The company has provided its contribution format income statement for March. And this income statement is based on 6,200 units. So I'm going to put this information down here so I can reference it. Okay, and this is going to be for 6,200 units. And I know I'm going to have to figure out my per unit because they want me to figure out what's the net operating income if I sell 6,400 units. Okay, so I want all of these to be labeled as dollars. And this is just a number. And this is just a number. Okay, so 217,000. Whoops. Variable expenses, 117,800. Now I know they gave me the contribution margin, but just get into the habit so you remember sales minus variable equals contribution margin. So that also tells me I didn't do any typos because I came up with the same number they gave me. My fixed expenses are 87,900. And again, contribution margin minus fixed expenses equals net operating income, right? I came up with the right number. Okay, again, that was just for 6,200 units. So to get to 6,400 units, I then need to figure out the per unit cost or the per unit sales price, variable expenses. So if I do total sales divided by the number of units for that total, and I'm going to anchor that cell, I get $35 per unit is my selling price. And then I'm going to drag that down and figure out my variable is 19. So I can now figure out 6,400, which I'm also going to anchor, times my selling price gives me my new total sales. And then drag that down, and that gives me my new total variable. So again, if I just take sales minus variable equals contribution margin, and now my fixed expenses, no matter if I make 6,200 units or my 6,400 units, my fixed expenses remain the same. So that's just going to equal 87,900. And then if I take that contribution margin minus the fixed expenses equals the net operating income of 14,500. Question 2. So let's see, what are they giving? Coster Corporation has 400 obsolete personal computers. So I have 400 of those. At a total cost of 576,000. Sorry. Holy cow. And I call total cost 576,000. So again, this is a number. And I'm pretty sure these cells are going to be dollars. I'll fix it later if it's not. Okay, what else do they tell me? If these computers are upgraded at a total cost of 130,000, they can be sold for a total of 190,000. Okay, so as an alternative, the computers can be sold in their present condition. So as is sale of 40,000. Okay, so what do they want me to find out? What is the net advantage or disadvantage to the company from upgrading the computers rather than selling them in their present condition? So they want to know how much more am I going to make if I upgrade them versus not upgrade them. So if I upgrade them, so right now I know my profit without upgrading them is 40,000. So what is my profit for upgrading? Well, the relevant information for that, the total cost that's sunk, so we don't have to worry about that. With the upgrade, it costs 130,000 and we could sell it for 190,000. So we take the amount we would get for the sale minus what it would cost to upgrade. And that gives us what the profit is. So then I just have to look at the difference between if I upgrade what I'm going to make and if I sell them as is. So it's the upgrade minus the as is, and that is the advantage with an upgrade. So again, whenever you're talking about advantage or disadvantage, first you have to figure out what are the relevant costs or numbers. So that's the $20,000 advantage. All right, question 3. Bowie Corporation, so we can see, okay. Fixed monthly expenses are 26,500 and its contribution margin ratio is 61%. Assuming that the fixed monthly expenses do not change, what is the best estimate of the company's net operating income in a month when sales are 85,000? So they tell me, well, okay, so there's 2 ways I can do this. So my sales, they're telling me are 85,000. And they told me my CM ratio is 61%. Whoops, I want that to be a percent. So then I can figure out my contribution margin, right? If I know what portion of sales, 61% of sales is my contribution margin. So even though they didn't tell me my variable expense, I can still figure out my contribution margin by using the ratio. So I take the sales times the contribution margin ratio. Whoops, that's a dollar, guys. Just being super helpful. So my contribution margin then is 51,850, and they told me what my fixed expenses are. They were 26,500. So then my net operating income is going to equal my contribution margin minus my fixed expenses. So 23,000 or 25,350. So that contribution margin ratio is helpful in finding the contribution margin if you know what sales are. Question 4. Okay. Farnsworth Television makes and sells portable television sets. Each television regularly sells for 290. The following cost data per television are based on a full capacity of units, 16,500. Okay, so this is a number, this is dollars. Okay. They count me direct materials, direct labor, and manufacturing overhead. 80% is variable and 20% is unavoidable and fixed. So that means 80% is avoidable, right? If 20% is unavoidable, 80% is avoidable. A special order has been received by Farnsworth for the sale of 2,800 television sets to an overseas customer. The only selling cost that would be incurred on this order would be $13 per television. So I'm going to do my direct materials, my direct labor, my manufacturing overhead that is variable, and then my extra selling expense is 13. Farnsworth is now selling 7,800 televisions through regular distributors each period. What should be the minimum selling price per television in negotiating a price for this special order? So essentially, all we really need to know is what is it going to cost to make, and it says per television, so per unit. So I just need to deal with per unit. So it's going to be $70 of direct materials for $50 of direct labor. And then it's going to be just the variable portion. So I'm going to go equals 60 times 0.8 for 80%. That gets me $48. And then I have that $13 cost. So to figure out the minimum selling price, so basically how much to just cover my expenses. So I'm just going to add up those costs, the direct materials, direct labor, the variable portion of the manufacturing overhead, and the extra selling expense. So $181 is how much it costs to make this special order. And so I need to sell it for at least that much to break even. I'd want to sell it for more to make money, but that's not the question they asked. They asked minimum selling price. Okay, question 5. Widely Incorporated produces and sells a single product. The selling price of the product is $170. Oh, good grief. There we go. Per unit, and its variable cost is $62.90 per unit. The fixed expense is $356,643 per month. What is the break even in monthly dollar sales closest to? So if you remember, break even, it has to, the contribution margin has to be enough to cover those fixed expenses. And to get it in dollar sales, I need to figure out what my contribution margin ratio is. So because I know my selling price, and this is per unit, right? I'm just doing per unit right now because that's the information they gave me. And they told me my variable expense per unit. So this was 170 and this is 62.90. And then this is the ratio. Okay, so I can figure out my contribution margin with that information, right? I can take my sales price minus my variable expenses equals my contribution margin per unit. Now to get my contribution margin ratio, I take my contribution margin, right, the part divided by the whole or divided by sales, and that gives me my ratio. So now to figure out break even in dollars, right, I will take my, oh, let's see, my fixed expenses, which were 356,643, and I will divide that by my contribution margin ratio, right? Because my contribution margin has to be high enough to cover those fixed expenses, and to get it in dollar sales, I divide the fixed expenses by the contribution margin ratio. And that gets me 566,100. Question 6. Okay, they give me this information. I'm Fair Barringer Corporation makes 3 products that use compound W, the current constrained resource. Data concerning those products appear below. Okay. Rank the products in order of their current profitability from most profitable to least profitable. In other words, rank the products in the order in which they should be emphasized. So I'm going to bring down all that information. Variable centiliters. W. Okay, so these are going to be dollars. These are going to be numbers. I have VJ, XS, QR, and then I'm just going to bring down all those numbers. 104, whoops, no typos, guys. 528, 12, 558, 6. And then my variable are 82.08, 429.75, 420.05. And then centiliters are 2, 9, and 9.2. Okay, so essentially that's the information they gave me. So now I need to figure out what the contribution margin per unit is. And that's going to be the selling minus the variable expenses equals contribution margin per unit. And I'll just drag that across, right? So it just takes those in each column for each unit. Now I need to know the contribution margin per centiliter of compound W. So I will take the contribution margin per unit divided by the number of centiliters equals the contribution margin per centiliter. So again, in each one of those, it's the contribution margin per unit divided by the number of centiliters gets me the contribution margin per centiliter. So they want it ranked in order from the most profitable to the least profitable. So this one is first, this one is second, and this one is third. So it's QR excess, which QR BJ excess. So right there. Okay, question 7. Sales in North Corporation increased from 60,000 per year to 63,000 per year, while net operating income increased from 10,000 to 12,000. Given this data, the company's degree of operating leverage must have been, okay, so this one's a little a lot confusing. So first off, I'm gonna just bring down some information. And so in year one, it was 60,000 for sales and 63,000 in year two. I know it doesn't say that, but that's the only way I can think about it. And then income was 10,000 and it increased to 12,000. Okay. So normally, let me try something here. Normally you would get your degree of operating leverage would be equal to the net operating income divided by sales. So in this instance, degree of operating leverage is X. And I need to find out the change, right? Because normally we would have, oh, I did that wrong. Okay. Normally we would have taken the degree of operating leverage and multiplied that by the change in sales to get to the change in net operating income. Right, that's normally how we do it. Normally we have the degree of operating leverage and we have the change in sales, and that takes us to the change in the net operating income. Well, we don't have the degree of operating leverage, but we will have in a moment the change in sales, and we will have the change in net operating income. So real quick, let's just do that. So the change is the 63,000 minus the 6,000 and the 2,000. So I want to convert that to a percent of change. So to get that, I'm going to take the change and divide it by the original sales. And that gives me a 5%. It increased by 5%. And then this one would be the 2,000 divided by the original net operating income of 10,000. And that gets me a 20% change, right? 0.2 is 20%, 0.05 is 5%. So I know, my pen again. I know, so I don't know X, I don't know degree of operating leverage, but I know the change in sales is 5%. And I know the change in net operating income is 20%. Well, the algebraic way, you've got to get X by itself by dividing both sides by 5%. So then X will equal 4.0. I'm going to show you that here. So I take equals the change in net operating income divided by the change in sales, right? That's what that is right there. Get X by itself and then X. Whoops, that is not a percent, that's a number. So the answer is 4.0. So hopefully writing it out like that, I didn't know how to put it in to Excel to show the algebraic way, so I drew on the screen. So hopefully that helps you understand that in this problem, the reason it's so confusing is that we have to work backwards to get to the answer. Okay, question 8. The constraint at John Grass Corporation is time on a particular machine. The company makes 3 products that use this machine. Data concerning those products appear below. Assume that sufficient time is available on the constrained machine to satisfy demand for all but the least profitable product. Up to how much should the company be willing to pay to acquire more of the constrained resource? So I'm just going to go out on a limb here and tell you they worded this question so badly. What they really should have asked was how much more than normal should the company be willing to pay to acquire more of this constrained resource, which is minutes on the machine. So that being said, there's my disclaimer. I will bring down my information. So my selling price, my variable cost or expenses, and my minutes on this constraint. My products are VT, UV, and LQ. So these are going to be dollars. These are going to be numbers. 335, 228.28, 199.03, 259.62, 173.44, 159.97, and then my minutes are 5.7, 4, and 3.7. So there's the information. Whoops, there's the information they gave me. So I need to figure out the contribution margin per unit. And then I need to figure out the contribution margin per minute, because that's what I need to look at. I don't want to spend more than what the lowest contributing product earns in contribution margin per minute. And normally then we would add that to what we normally pay per minute, but they did not give us that information. And that's why I feel like they worded the question wrong, but we're gonna get there. So again, contribution margin per unit, you take the sales minus the variable per unit, and that gives you the contribution margin per unit. I'm gonna drag that formula across and show you that in fact it is the sales minus the contribution, or the variable expense equals the contribution margin per unit. Now to get the contribution margin per minute, I'm going to take the contribution margin per unit and divide it by the minutes on the machine. And that gives me the contribution margin per minute. So I'm going to drag that formula across. And again, it's the contribution margin per unit divided by the contribution margin per minute. So which one of these is the least? Well, it is LQ. So I don't want to pay more than $10.56 per minute for extra time on the machine. And again, normally that would be added to what it normally costs on the machine, but they did not give us that information. Okay, question 9. Tripoli Incorporated has an operating leverage of 5.3. If the company's sales increase by 11%, its net operating income should increase by about, Okay, so again, operating leverage is 5.3. Sales increase is going to be 11%. Oops. So the definition again of operating leverage is how much faster net operating income increases according to how much sales increase. So in this case, our net operating income is going to increase 5.3 times faster than sales increase. So I will take my net operating leverage times my increase in sales for a percent increase of 58.3%. Question 10. All right. We are management Fan Incorporation is considering dropping H58S. Data from the company's accounting system appear below. They don't make this clear, but this information is just regarding this H58S. So total sales is just for this part or product. In the company's accounting system, all fixed expenses of the company are fully allocated to products. So that just means they divide that expense across the products that are sold. But that doesn't change the fact that they're fixed expenses. What does change the fact that they're fixed expenses is further investigation has revealed that 215,000 of the fixed manufacturing expenses and 176,000 of the fixed selling and administrative expenses are avoidable. So if product H58S is discontinued or dropped, what would be the effect on the company's overall net operating income if it's dropped? So we're just going to look at what's relevant. So sales are relevant because if we drop the product line, that we're not going to make these sales. So that's going to be a negative, right? Because it goes away, negative 940,000. Okay. If I don't make this product, then my variable expenses go away as well. But because they are expenses that I don't have to pay anymore, that's money in my pocket. And so that is a positive if we're talking about dropping a line. Now they told me the avoidable, right? They are avoidable. So 215,000 of the fixed manufacturing overhead. Is money I don't have to pay anymore. So that is a positive. And then the fixed selling and administrative that is avoidable is the 176,000. So now because I have my sales is a negative because I'm losing sales and my expenses are positive because I don't have to pay them anymore, I can make Excel sum those numbers up for me. And then I will be able to see what the effect is. So the effect will be a decrease, right? Because it's negative of $170,000. Hope that helps. Good luck on your exam.